Prateek Agarwal joins us. Let's take the conversation forward. Prateek, good morning. Prateek, what's your view? Are markets now fully priced, and do you think now markets are due for a prolonged period of consolidation, and it is best that if we consolidate here?
Yeah, so I would agree with you. We have had a good run from the bottom. Now on most valuation parameters, we are looking more expensive than historical levels, or on average, even on bond yield to earnings yield kind of parameters. So while there is an upside, and we do believe we will get there, let's say the earlier highs over the next few months, but for some time it is good to consolidate where we are and let the economic activity pick up. That will give more legs to the rally.
So then what are you doing with the portfolios which you manage? Are you moving towards a defensive bias? Have you changed your portfolio allocation, considering that right now gold is available at the price of gold? I mean, it is not March or April where gold was available at the price of silver.
So we have actually reduced the defensiveness of the portfolio. Okay, if you believe that being in consumer staples was being a very defensive positioning, while we have retained most of the names, we have taken money off the table as a natural process of rebalancing. So our consumption portfolio weightage has come down, and we have introduced more of technology services, chemicals, and pharmaceuticals. So that change has been done. Most of the spaces that we have added have a strong tailwind of growth. These spaces should do well this year, and the growth should continue into the new year, next year as well. So with that thought, we have changed some bit of the portfolio. Moving away from consumption, was mostly on valuation considerations.
Prateek, have you participated in any of the banks and the QIPs which have come out? Because looking at the kind of investors a ICICI Bank or an Axis Bank or a Kotak Mahindra Bank has got, good quality investors have moved in. Are you ready to digest? Are you ready to digest and accept a near-term volatile patch with a promise of better days ahead for some of these private banks which right now are on a binge to raise capital?
Yeah, so we are not an institution by the definition of the regulators. So we don't qualify to be part of a QIP process. We are seen more in terms of regulation as a PMS, more like a HNI entity. So no, we have not participated in the QIPs, but that said, we have exposure to some of these names. We like retail financial businesses. We have actually bumped up our financial sector exposure, mostly on the retail side, both on the NBFC and banks and insurance. Actually, all three spaces we have increased a tad. Insurance would benefit from much better awareness itself for life insurance and health insurance spaces, and they are the more profitable spaces whenever normalcy comes in. Retail financials, let's look at it this way. Everybody in financials may get impacted, but there are entities which will marketplace will have increased financials, and two, with higher liquidity, NBFCs, who suffered from the inability to accept deposits in the manner banks can, their deposit franchises even for NBFCs who do take in deposit is weak. Now that weakness goes away. So we have seen most NBFCs being able to now raise monies both equity and bonds. Many of the better NBFCs have taken the opportunity to actually reduce ALM and increase the duration of their borrowing. So we do believe as things get normalized, NBFCs are also surviving. Retail focused good NBFCs are also very nicely positioned.
Sure. Prateek, where would you be tempted to take profits off? And do you think right now, with the way the markets have moved and these individual sectors have moved, maybe IT, pharma, you need to take some chips off the table? Or do you think the long-term growth story is intact and staying put is the way to go when it comes to IT and pharmaceutical names?
No, so we would be staying put. These are spaces where growth will come by, and this is a thought that I want to share. As liquidity becomes amply available, the capex intensive spaces get overbuilt. You start with a situation of overcapacity; they get even further overbuilt, and taking out consistent profit increases from that spaces becomes very, very difficult. So spaces where one can build a scenario of continuous longs would command higher valuations in the marketplace. That's our belief, and with that, we want to be with such spaces. Technology, pharmaceuticals, specialty chemicals, and even consumers and retail financials, insurance are these spaces of choice for us.
Okay, so that covers the sectors so far. And Prateek, what are the major triggers that you'll be watching out for now going forward? I mean, globally, of course, we are aware of what may take place in terms of elections, etc. But what about back home? What's the next trigger according to you?
Yeah, so people are tracking the quick data that comes by. After June, July was a bit soft. I mean, while the recovery continued, the pace of recovery definitely reduced. Different parts of the country went into the lockdown. So the strength of recovery is clearly being watched. The thesis of the market going back to the earlier highs is contingent on the recovery continuing to be strong. So that is one. Second, and with lesser inflation, because the other big ingredient in the market valuation sustaining where they are is lower interest rates. And we did not have a cut in the last policy. Now people are saying we may not have a cut in the next policy given where inflation is. So those would be the two big things to watch for in the domestic context. And yes, globally, given that a large reason for what we are seeing is liquidity, these steps by the central banks to further keep the liquidity high is something that would be keenly watched.
And while we've sort of understood the sectoral exposure, Prateek, given the bounce that we've been seeing in broader markets now, would you also start to expand, some of your picks, or would you still stick to perhaps those frontline names, given the uncertainty also that continues?
So I think the broadening of the market is a very good news. I think in part because of improved retail participation, that has stood out. For the first time, we have seen retail come in the manner that they have when the markets were down and out. The kind of confidence retail has put on the India growth story as a lesson for all of us. We do believe it's a positive, it's not a negative.
I keep on making this point that Gone are those days where we thought that the Indian retail investor was a non-sophisticated investor who came and created market tops. I've been making this that what is the same turfs which apply for sophisticated investors like you, they also apply to retail investor because of technology, because of media, because of channels like ET Now. The retail investor is far more nuanced, far more informed, and much more authoritative in terms of taking a decision. So Prateek, let's say if I have to talk about your portfolio in February middle versus August middle, what changes have happened because of COVID and because of market sell-off?
Yeah. So, what are the spaces that are seen to be growing, and what are the spaces which are expensive? So, our portfolio was nicely positioned for COVID, but maybe it was a tad more expensive, maybe it was a tad more conservative. So, de facto, if you see our positioning then and now, you will see close to 10% taken off consumption names, and that going into technology, pharmaceuticals, chemicals, and retail-oriented financial. So that's the 10% going that has been very visible.
I was speaking to a very large private banker, Prateek, and his view was that, and this is one of the top banks, his view was that, look, I don't worry about corporate moratorium so much as much as I worry about retail moratorium, because in India we've not seen a real down cycle in a decade now, over a decade, and we've not seen a down cycle in retail. And let's be very clear, Prateek, here that retail job losses are there, retail salary cuts are there, retail bonuses are not going to be there, and retail income, which was growing at a steady rate because of inflation and other factors, is not going to grow. So do you not worry about banks and financial institutions which until now have made great franchises on the retail portfolio, whether it is Bajaj, HDFC Bank, even ICICI Bank now?
So look at it this way. So you are right on all the count if you look at the near term. But at the same time, you should temper it by believing that the expenses would also be lower. And this is something that we are hearing since the expenses are lower, for many people, the ability to service debt is that much higher. The other way of looking at the same thing is, do we in financial 22, which is not too far away, looking at economy which is stronger than pre-COVID? Typically the answer to that would be yes. We are talking of April, May, June kind of a period next year. And while I said that already in the festival season, auto guys are planning all-time record production. So there is some degree of conservativeness in what I am saying. It is not an aggressive statement. Now, if we believe that the Indian GDP levels, the growth outlook would be similar to what we saw pre-COVID, then that would be achieved only with people back on jobs. Okay, that will be achieved by salary cuts getting restored. Already you are hearing people having to pay more to get workers back on jobs, and there would be also some amount of, not much, but some amount of comp increases as well. It is this distinction between near term, which is full of uncertainties, versus slightly medium term, 7-8 months down the line. If 7-8 months down the line, as an economy, we achieve pre-COVID, we have several tailwinds also backing us, then chances are that this would be achieved with people back on jobs with similar comps or higher. And if the retail lenders have done a good job of selecting their borrowers, then those borrowers should be good enough to sustain for the interim period. So my sense is the fears on bank losses or NBFC losses are higher than what would actually happen. Yes, there may be a timing mismatch. So in banking financials, there is one parameter which is GNPAs. Now that is not same as loan losses. If a guy gets okay to pay 3 months later, he will put the money back, and if it is supported by some restructuring, etc., it may not even figure in GNPAs. So my sense is the fears on the financial space is significantly higher versus what would happen, especially for better financials, retail-focused financials. And this is a space which is even today significantly lower than the highs that they saw, and does provide an opportunity, especially as the economy recovers and attains normalcy. Here again, there are entities which are not able to raise money and would hence not be able to compete in the normal period or compete less in the normal period. So be with the businesses which are retail, who are today having leverage less than the peak that we saw pre-COVID. They have raised money in the interim. I think those guys should be much better positioned.
Okay, Prateek, good to have you on the show. Thanks as always for taking the time out.